Let's look at the most eye-catching and insightful market data of the past week, particularly in a very volatile week. Okay, so the first thing I wanted to show you was this. I looked at today's Dow 30 stocks, the stocks which are in the Dow Jones Industrial Average, which only has a list of 30 stocks in it. How did they perform during the last market crash, which was essentially all of 2008? And as you can see, there's very few stocks in the Dow today which back then were up. In fact, there's only one which is up in both periods so far, although, of course, we're only looking at the first couple of weeks of the year this year. Amgen is one of them. That's not to say Amgen is a buy. The key points I want to make to you is this. Very few went up in that crash. So if you're thinking that if the markets continue falling, you're going to find some magical big name company which is going to go against the tide, you're wrong. The other thing to note is so much for diversification, right? Guess what? These come from a variety of sectors. Everything's correlated to the downside when the market falls sharply. I also want you to note that even the biggest companies can drop by 50%. Most people underestimate how much a giant can actually fall, or indeed that it can bounce back. Okay? Yes, stocks rebound, they often do. Fallers have nothing to do with the causes of the crash, but those that are linked to the causes of the crash will fall more. Global stocks, worst week last week since October 2020, right? Minus 4%. But then again, when we say since October 2020, that was only pretty much yesterday. For the Nasdaq 100, worst January pretty much ever. This is how far things can fall, though. So I want to counterbalance how much they've fallen in the past week with actually, or in the past month, by how much they actually can fall. They've barely tipped. If you look at the bottom half of that graph, the drawdown in percentages, it can be down minus 30%, minus 20%, minus 10% is not uncommon. So it's been a roller coaster. We know this. This is the S&P 500. It swung from 4% drop to a gain. It did that in a day, and it's done that a couple of times. Basically, what it means is there is a massive division of money and the direction it thinks things are going to flow in. There's a whole wall of money which thinks has been spoiled and thinks we can keep going up. Some of that might be retail, and there's another wall which says a lot of it which is institutional. We're overvalued. This is one measure of valuation, so-called Shiller PE ratio, and you can see at the moment we're pretty much at all-time highs. So that's the argument for selling, and it's a strong argument. What this shows here are the various indices and their January 2022 performance, and the worst month since by way of monthly performance. So you can see S&P 500, well actually, a lot of these indices, of course, have had worse months, but some haven't. So it's a good comparator to put things into context. It was pretty bad. January this year has been pretty bad, and it's been comparable to some of the worst months for some of the indices and not for others. But it was bad, and you didn't need data to tell you that either. Okay. Percentage of members of the S&P 500 with a positive year-to-date return, 1 in 4. It's not bad, actually. At least 10% drawdown, 47%. So you're not in bad company. If your stock is down 10%, that doesn't mean that that's a problem with the stock. It's actually a problem with the market. And if it's a problem with the market, it's less of a worry than if it's a problem with the stock. At least 20% down from its 52-week high, 44% of stocks, 44% of stocks, or 75% of Nasdaq stocks. Now, this is where it's interesting. With the S&P 500, you might say, well, if 1 in 5 of a diversified index like the S&P, 1 in 2 is down, pretty much 1 in 2, 50% are down, 20% at least, then it's not a problem with the stock. It's more the index because it's a diversified index. Here, if they're down 50% and only 2% up, then you know that's a problem with the stock and not the index, because very few stocks are down that much, so it must be a stock problem. Now with the Nasdaq, it's a different story because it's not a diversified index. So when 75% of those stocks are down 20%, that suggests it's a problem with the index and the nature of the stocks on there. Okay, and similarly 50% are down, and they're mainly technology companies. So there's a subtle difference to be noted there between those two types of indices. And when it's a stock issue, in which case you might want to get out of the stock, and when it's an index issue, in which case you've got less things to worry about. Again, another version of the S&P 500. Enterprise value, we're looking at price to book, we're looking at price to sales, all measures of valuation, and what it suggests is it's pretty much as bad as or worse than the dot-com boom if you were to look at that metric alone, and you should. So there's a strong case why markets might continue falling and the recent rebound we've had won't last. What about global indices? Well, the Indians are leading the way, followed by the Brits. Don't often say that, do you, in any context? And then lower down, you can see where the Americans are, and most global markets are down. Does that mean we should look at international diversification, such as the UK and India? May well be worth looking at, yes, depending on your risk profile. Now, what are my projections? Well, I've marked these with the S&P 500, going back the last 11 years to provide some context, by A, B, C, D. A is where I think we just continue going in the same accelerated trend we've pretty much had since 2020. Well, I think there's only a 10% probability of that sharp trend continuing. And the reason I say there's only a 10% probability of that sharp trend continuing because it's too high, it's too steep. It's an angle of attack or angle of inclination, which is so high, it suggests that we just keep on adding market cap to the stocks even quicker than the economy can grow or profitability can grow. Not realistic. I think the more likely scenario is B, which is that red dotted line all the way, which has lasted since 2011. And I think we'll probably resume down to that. So that means more further falls, and then we continue going upwards. So at least we still get growth, but we've got to take some profit taking, and that profit taking will only take us back to 2022 levels anyway. C, moderately likely, could happen. Again, takes us back to 2018. That's why I don't think it happened, because there's been so many economic benefits since then. But D is the sort of the level that the worst pessimists think, the ones who think there'll be a 50% drop. If there's a 50% drop, and I only think there's a 10% probability of that, then we're down to, well, March 2020 levels. Basically, the lows of March 2020 and 2016 levels. That's why I don't think it's that likely. Okay. I want to give an example of Microsoft, but a lot of people ask me, well, it's a good quality company, results just blew the doors off, should we get in? If you're risk loving, you'd get in now, because you'd say, you know what, I'm not going to try and time things perfectly, I'll get in, look at it, it's a good company. If you're risk averse, you might say, look, the market's got further to go, I just don't want to be in equity, so I'm going to wait, or I'll pound cost average or dollar cost average into Microsoft. I'll put a third in this month, a third of my allocation next month, a third the month after. If you're trying to time the market, you would say, well, I'm looking at the momentum indicators. I want the MACD. This is a monthly chart. Each one of these bars is a month. I want that, which I've marked B, to be flat. So it shows the downward momentum has at least stopped. And I want the stochastic on the monthly to be going up. So A to be going up and B to at least be flat. That's if you're a timer. You can imagine from what I've just said, a lot of people say, I'm not timing. Pfft, are you kidding me? Volatility, pretty sharp, okay? Right up there. Well, it should decrease a bit. It doesn't tend to stay at those elevated levels for very long. And what this shows is the S&P 500 calendar year return versus intra-year declines going all the way back to 1980. So you can see you can get a 29% return. You can see that the intra-year, it dropped minus 5% or minus 34% or minus 20%. So you can see you can have positive years, but actually quite large falls over there. Take a pause, have a look at it. I also wanted to show you this statistic. And again, I'm going to use something safe like Microsoft as an example. There were 121 instances in the last 10 years where Microsoft stocks saw a trailing 21-day drop of 7.6% or more. Okay, 95 of those instances, Microsoft rose over the subsequent month. So that's a case for those saying, well, I know the market might fall. I just want to buy into this stock. And I don't want to wait. I don't want to pound cost average. I don't want to try and technical analysis time it. I'll just get in because I know statistically I'll be fine. Right? So that's the other way of looking at things. I want to show you something else. And this comes from an old article from 2001. And it's from a time when I was a visiting fellow at Oxford University lecturing on behavioral finance. And I was digging up some of my old papers, and you'll have to pause this to read all of this in terms of how people behave when markets fall. So feel free to pause. But what I want to show you is this from the same paper. When a stock falls, there's two paths that can happen. Now, it falls initially, like in Netflix, and then it falls further. And you've got to make a decision at this point. Is that fall something which is going to go back up, or is it going to fall further? It's more likely to fall further after that initial drop if the bad news was hard, like a profits warning, or downsizing or whatever. And it's more likely to bounce back if the path was soft news, like forecasts and plans. And Microsoft, a classic example of that, where actually it wasn't anything with negative news to do with the company, which I initially felt, and then starts to rise. Netflix is an example, or Peloton, where it falls and then falls some more. Or Robinhood, falls some more initially and then continues falling. And people sometimes confuse. They see, say, a Microsoft bounce back up, and they say, well, my rubbish company will, like Peloton, will bounce back up as well. I'm not saying Peloton's rubbish, but my company which fell. There's another issue with these short-term falls, and what might give you more perspective. This is the return distribution of, again, I've given Microsoft as a simple example. Over 20 days, you can have, although there's less probability of that return happening over 20 days, as much as a 29% drop. But you can see how you can have quite steep declines over a 20-day period. Over 250 days, it's far less likely you're going to get that. Not guaranteed, because this is historical data that this is based on, but it's less likely. This is what people mean when they say buy a good company and hold it through short-term volatility. You can only hold it through short-term volatility if it's a good stock, because if it drops, then you can hold it through that short-term decline on the expectation it'll take that path as opposed to this path. And which ones are more likely to have only soft news to bring them down, or market news? The ones which meet my various criteria of valuation, growth, income, cash flow, and so on. Have a look at my campaignforamillion.com to understand all of that. A lot of free resources there to help you. Also wanted to just show you this for the month. And you can see, is money going into which markets, which global markets is it going into? Well, there's Middle East, there's, by way of emerging. United Kingdom's probably the only, is the only major one there, which is up and is a major economy. So the others, you can see the returns. Obviously Russia, and you might say, well, I'll take a punt on Russia. If you want to gamble, go for it. I thought that might be useful. This, again, pause, it's the final slide, and it's taken from the Financial Times. It's rather good. It shows, they describe a graph of value versus growth stocks, and they explain why one might do better than the other, but more importantly, the fact that it's an oversimplification. Okay? So given that debate of is it value stocks or growth stocks is going to continue, I thought you might want to read that again. Please feel free to pause. Go to campaignforamillion.com or alpeshpatel.com and you'll see the various free resources that I provide. Join me on my free Telegram channel, follow me on LinkedIn, and you'll get more of these through that. Okay, thank you all very much.